the orbit. It is Monday, May 6th. This is Income from Options Weekly, where we look at the setup and the premium levels, the vol levels for those that like to sell options, either 0 DTE or further out into the week. So we've got the market up higher. We are just more than 0.5% higher on the day. That continues the rally from the last few days of last week. You can see those gaps higher. If we zoom in, we had another gap higher and we have gone more or less sideways. We opened up just below 51.50. We have creeped as high as almost 51.60. Now, something to point out, we talked about this at the end of last week, volatility has collapsed after the FOMC and the jobs number. And then you throw the weekend into that and a weekend effect of options getting lowered into Friday's close, options premiums. And then you open up Monday, and if you have a gap lower, a lot of times those low vols correct and they get pumped back up on the open. Today, we had a gap higher, which meant they arguably even went lower than Friday. And right now we are looking at an expected move of under 0.3% for the rest of the day. You can see that IV in the top right. We are under 15 IV 0 DTE. And to put that into perspective, some of those days last week, like Wednesday, we saw IV 0 DTE IV above 40 and near 50 and above 50 at moments there. So that just gives you some perspective of how low 15 0 DTE IV is. Going out to the rest of the week, it remains the case. We see 12 IV pretty much out till Friday. So this is as low as we've seen vol in quite some time through all of this volatility. So that is options market makers and options traders are basically pricing for this week to be a slow week with potentially a grind higher. Now that could change on a dime. The first rally like this that sees sellers and takes it back down into the red, you will see 0 DTE vol get back above 25 in a situation like that. But for now, they are keeping it in the low to mid teens, and that is likely an effect, an after effect of a lot of options being sold and the market getting loaded up with some gamma for now. On the horizon, the short horizon, out to next week, we have a CPI number. And that the significance, it's right here on May 15th, and you can see it goes from about 10, 11 vol up to, almost 13. So nothing extraordinary, but you should keep that date on the calendar if you're trading options out a week or 2 weeks, in that options that are expiring that capture that CPI on the 15th, that volatility should stay bid. Even if we see real sideways movement this week and we see vols get crushed, we see the VIX get crushed, it will hold for May 15th, 16th, and a little bit after that to incorporate that CPI into the premiums. And if you're an options buyer and you're looking for some directional positioning, you might want to look out beyond that 15th or 16th, because it will be somewhat protective of that premium and of that theta. In fact, it's most likely that going into the CPI, what is now priced as 13 IV, it's likely to be closer at least to the high teens going into the CPI, and 0 DTE going into the CPI is likely to be above 25. And if you see any sort of negative market reaction, that's when you see that 0 DTE and 1 to 2 DTE vol get up pretty high into the 30s potentially. So that's something to keep in mind. As far as the rest of the day, traders need to be very aware of this low vol. So if you are a premium seller, if you're selling iron condors, if you're selling credit call spreads, you have to be aware of how close that is. And so let's look at a credit call spread expiring today. And the strikes we get are 51.70, the short strike. And so that's against 51.58 in the spot right now. And so that is, you're talking 12, 13 points higher, and you still have the majority of the trading day left. We still have almost 5 hours of trading. So you have to be very aware of how close that is. And perhaps you've already seen the movement. We go sideways around 51.50, but the market opened at 51.49 or so, and we've already gotten up to 51.60. So if you are selling credit call spreads into that, you have to be aware that you might only be 15 points away, and perhaps you need to go out a little further to get some more room. And then of course you see these premiums drop. So now we are at a 50 max gain, risking, or 60, risking 440, but you are up at the 51.75 short strike. And the same thing is true for the downside. The same thing is true for iron condors. Now, going back to the entire week, let's look at the iron condors levels for the entire week and go out to May 10th here. And you will see the same thing. It's barely below that gap higher on Friday. You can see those strikes down to the downside. And let's come in here and let's look at them. The short put 51.10, the short call 52.05. If we expand that a little bit, make sure we're up above that 5200 level, get that short put below the 5100 level, and you can see you're about 150. Take that even wider. Let's get it down to that 4-to-1 and see where we are. So now we're at the 50.75 to the downside, 52.40 to the upside. If we look at that on a 1-month chart, we can see the level. So you're about halfway retracing that move from those lows. From at the you're basically, your upper strikes are up near that high from a couple of weeks ago. So that gives you a sense of where that positioning, where we are in the market. And if you were selling the entire week, you can see it pretty clearly. There is a decline from here back to the lows would obviously put this trade at risk. And then a grind higher, a slow grind higher, you have coverage up until near those highs. And in that case, volatility would stay low. If we reversed and we went lower, volatility would expand. And that's the moments for, to potentially be looking at legging into credit put spreads when that vol increases. And at least you get some good premium for those sales lower. Something to keep an eye on, as always, is what's going on in the bond market. This is the tail wagging the dog of the stock market. So right now, TLT basically have it unchanged. It's moved, gap lower, found some buyers. That's usually a good sign. Continue climbing up above 90. If you saw this declining back towards these lows from last week, that could put pressure on stocks. The other thing to check in on is oil and what's going on there. We've got that up today, but if we look at the bigger perspective on a 3-month chart, you can see it's declined pretty significantly off these highs. At this moment was the worst moment for the stock market, and what that was USO really high and TLT really low. And that's about when those two things reversed, when TLT held and when USO started to decline. That was sort of the top tick of the VIX, and it was near the bottom tick of the market.